Okay, welcome to the fall webinar series, session number 2. Last week, we went over the contract with Frum. It was an excellent conversation. Our focus during this fall webinar series is key strategies to increase your ROI. We all hear contractors complain all the time that it's so difficult to make money in this business anymore. So we're focusing this fall on bringing to you some ideas on that you don't hear all the time on how you might be able to improve the investment return in your business. One of the keys to being able to do that is understanding the environment that you're in. We had a very well-attended webinar back in the spring with Matt Woodruff, top analyst on Wall Street that covers transportation and aerospace. He's a specialist on FedEx itself. And today he's back with us to kind of give us an update on the 2024 budget year, shall we say, and then what went down last week in the FedEx announcement, quarterly earnings announcement on the 19th, and what that looks like going forward. Okay, Matt. Again, welcome everyone to the fall webinar series hosted by My Ground Force. I'm Tim Goff, your host. And this week, we're really excited to have Matt Woodruff back with us. He is an expert on the aerospace and transportation sectors on Wall Street, and he especially covers FedEx and UPS. His presentation to us back in the spring was extremely well received, and he's been kind enough to come back and give us an update on where things are with FedEx financially and what their plan is and how that might affect contractors. So without any further ado, I'm going to turn the floor over to Mr. Woodruff. Thanks, Matt, for being here.
Tim, thanks so much for having me. Just a little bit on Credit Sites, who I work for. Credit Sites is the largest independent credit research firm on Wall Street, and I have been covering the transportation industry for them for the last 3 years, as long as I've been there. And FedEx is always a topical name. So happy to talk about FedEx today. Okay, so happy to provide an update on the last 6 months since we spoke on FedEx and what I've been seeing, what's been going on in the market. Just in general, I'm sure it comes as no surprise to you all, transportation market has been extremely challenged over the last 6 months. Really been in a recessionary environment in terms of volumes within the whole industry and within FedEx and UPS as well. Have really seen the transportation names and these stocks have underperformed the market by a decent amount. And as you're seeing here, I've got the last 3 years on FedEx and UPS both, and both have not done well. Dramatically underperforming the S&P 500 and even underperforming their transportation peers. UPS has been particularly bad, down 24%. And I won't get too deep into UPS here, but most of that decline that you've seen with UPS has really been on volume disappointment. And so UPS, much like FedEx, is calling for the second half of this year to kind of be a bit of a comeback in terms of volumes. But it's been a real challenge for UPS really over the last year. When they had a threat of a strike, they saw a lot of customers that moved over to FedEx, and it's been a volume challenge for them since. But both of these companies have severely underperformed. Looking at the white line, it has really FedEx, and you can kind of see how that performed on the white line there. And what you see is a crash in September 2022. That's when the COVID volume started to come off, right? So we had this nice period where very strong volumes coming off of in the post-COVID period. And then suddenly, September 2022, the COVID volumes came off. And that's when management decided they needed to start taking out costs in a major way. The Drive cost takeout program was then revealed. The stock recovered for the most part and did okay until hitting first quarter earnings on September 20th. And that was a tough day. So that was down 15%. And we'll get into why that was on the next slide. here's a summary of what happened with this quarter. You can kind of get a sense in the upper left-hand corner there. No matter what the market was looking for with FedEx, FedEx missed the consensus expectation here. So we're talking about revenue, operating income, earnings per share, free cash flow. It all wasn't good. And so no surprise then, the stock was down 15% on the day. FedEx also reduced their full year guidance for the year. From a revenue perspective, the old guidance was up low to mid single digit. Now the guidance is low single digit. From an EPS perspective, narrowed that top end of the range and actually upped capital expenditures by a little bit. They went even further than that and said that the second quarter of this fiscal year was expected to be pretty bad. And they attributed that to the unfavorable calendar, which is not going to include, because Thanksgiving is so late, is not going to include that Thanksgiving shopping period in the second quarter this year like it typically would. And so they're saying, hey, this is a second half comeback story. Wall Street does not like second half comeback type of stories, and so the stock sold off, pretty severely. Just look at the details here, and as far as volumes for the first quarter, total average daily volume was flattish, just slightly down, 0.2% year over year. Ground economy was a positive 0.4%, so decent there, and ground commercial was flat. Where the volumes were quite weak was on the express side. U.S. priority was down almost 5% year over year. U.S. deferred was just slightly down. From a revenue per package perspective, mostly flat on the U.S. ground side for year over year, but that was a positive on the FedEx Express side, the air side, U.S. priority plus 3.3%. And then lastly, the purchase transportation was up 3% year over year for Express. So remember, is from an outsider's perspective at this point, FedEx Express includes FedEx Ground now. So FedEx Ground is just viewed from a segmentation standpoint, from a Wall Street standpoint, and how FedEx is presenting the company to the outside world at this point. It's just viewed as one service, one product that is offered by FedEx Express. So when I say Express in here, I'm really referring to you guys, to Ground as well, because it's all viewed as the same thing at this point. The segmentation has changed, so it's not as easy to tell what's going on with Ground at this point. The financials are kind of blended between Ground and Express. But reading between the lines and what happened here, it does seem like Ground performed if it was a standalone basis, considerably better than the Express unit performed. So the next slide, we kind of get into what's going on with the other segments and also the air freight segments. So at freight, which remember, this is the LTL business, we saw volume declines there as well, 2.8%. Revenue per shipment actually increased there slightly. From a FedEx air freight perspective, significant declines there on the air freight side, and that was, down 3% is really what the number was there from a revenue perspective. The international priority was down 5%, and then the U.S. stuff was down 10% year over year. So not great from an air freight perspective, and that was one area that I think the Wall Street expected them to do, significantly better than FedEx, actually did. So at this point, I think, what would be good, just to give you an idea of broader picture of what, the market's expectations were, I think it'd be good to go through the different initiatives that FedEx had laid out to the market. And the first one, would be FedEx Drive. Talked about this last time. FedEx Drive is aiming for $4 billion in cost savings. And one 1.8 billion was said to be achieved last year, and then on the call they said they achieved 390 million in the first quarter as well. Well, if you look back at the financials and what they posted, they posted an operating income, a significant operating income decline in the quarter on a year-over-year basis. So significant that investors really had to question, oh, what is really going on with this cost takeout program? One of the knocks on FedEx historically was that when FedEx goes to take out costs, they tend to find ways to spend it. And certainly this quarter would indicate that Drive is moving in that direction. And certainly what we saw in this quarter was, despite significant cost takeout that was claiming to be had over the last year, it's really not dropping to the bottom line. And so, what was that, and why is that? Well, interestingly, the cost or the expense item that went up year over year was actually the purchase transportation stuff that I mentioned earlier, and that was up 3%. Now, for you guys as FedEx ground contractors, that is your expense line. That is where the cost of FedEx ground flows through. It's through purchase transportation. And so, but the reason that FedEx gave for that increase of 3% year over year was not actually at ground. They said that they
We
spent
lost
more
you.
money. Yeah.
Say that again, Matt. The reason?
So the reason that they gave for the increase in cost there was not on the ground side. They actually said it was through express, driven by contractors used for international economy. So they saw, significant increase in contracting expense for international economy. They did not present or clarify at all, what was going on with FedEx Ground, but that was the main expense item that increased for the year. It was international economy, and so, just kind of looking at it from an analyst perspective, it seems like that is the way that they have managed to spend some of these savings by doing more contractor work on international economy, which is, would be on the historical express side as opposed to ground. So it seems like Drive's not really working, right? Is the bottom line. That's the punchline right there. It's not taking out the cost savings that they're claiming at this point. And if it was, you would see, an increase year over year in earnings, and we're just not getting that. Now we're just in the middle of it. We've got a long way to go. They're claiming 2.2 billion of cost savings total. I lay out here on the slide. This is the same slide that I presented last time in terms of the different savings areas that FedEx has put out there. So the one that applies to you all, the ground line haul ops, 450 million of cost takeout that they expected to get there. On the ground docks ops, 300 million, and then P&D side, 150 million, and then they expected to take out 300 million from the express side. All that together is the ground network cost takeout that they expect to get through Drive. And so presumably, a lot of this is going to be happening, right now, this year. We're going to start seeing some of this, and one of the ways that they could be that could meaningfully affect the ground operations is through using rail. Rail is a big, largely used by UPS. Is a low cost way to move parcels across the ground. And certainly FedEx has highlighted that that's going to be one way that FedEx will use or will use more in the future as a way to take out costs. And so they had said 8 to 15% more miles of rail. It's kind of the expectation, and I expect to start to see those cost savings to start to come in here over the next year. Some other things that happened, we talked about the One FedEx program where they were consolidating a bunch of legal entities. And I talked about how, hey, they're not putting FedEx freight in there, right? Well, guess what? Lo and behold, they are going to evaluate whether they should be keeping FedEx freight, the LTL business, um, in the FedEx fold. And we're going to find out how that review goes by year end. So they didn't, they did make reference to it on the call, but they said, they're not ready to talk about that just yet. So we'll see how that review goes. Outside of Drive, there's other stuff going on. Of course, there's a lot going on with FedEx. On
So,
the next slide,
Matt,
oh,
if you give
sorry,
us a
Tim.
chance, we're going to switch
Sure.
presenters, and then I have a couple things that I want to ask questions about.
Absolutely. Yeah, please do.
Yeah. So go ahead, Allie, if you want to present. So the first thing is you talked about rail. We had a pretty good increase in folks reporting that the rail use has gone up. It's interesting. It's kind of anecdotal, but I hear a lot about empty trailers going back and forth on rail rather than paying line haul contractors to move that. There's always a shortage on the West Coast of empties.
Okay.
But then, of course, the question is there's not a lot of loads going west, so contractors going out there to pull loads back east are going to have to go with empties oftentimes. So,
Yep.
I just wanted to let you know about that. And
Okay.
as far as there has been a tremendous optimization effort. There's been a lot of contractors, and I'm going to send a poll question out here in a second. There's been a lot of poll questions impacted by this optimization effort, shall we call it, or there's been a lot of words used for it, but I'll just use the
Yeah.
word optimization.
Yep.
And essentially what's happened is FedEx has gone out there and looked for any run in which it's rarely running empty in one direction. And they cancel that run. And then they run the one direction loaded with purchase and then let purchase figure out how to get back, at their own expense. But they have canceled. We haven't seen this before in the history of FedEx Ground. They have canceled hundreds of assigned runs, which has had a direct impact on contractor revenues. They've also then gone through this process they call optimization, in which they look at each individual line haul run and using Google Maps essentially figure out if there's a shorter way to do it. And so they've done a lot of taking trucks off of interstates, which is typically safer, and putting trucks on 2-lane highways that are still truck routes that might be 20 miles shorter in one direction. And they save a lot of money doing that, but they've increased the risk factor for contractors. So that's kind of some anecdotal from the ground deck plate, shall we say, how the implementation of Drive is being received out there. It's been a major hit on revenue in many places, and what's going on is much different than what we've seen in the past. Yeah, there we go.
So we were on, Network 2.0. Perfect. That's good color, Tim. So it seems like, there's some cost takeout happening, but it's interesting though, in the aggregate, Tim, they're not able to actually reduce their overall expenses. It's a shame that it hasn't happened yet. Still not done, so we'll see what it looks like, at an end state. But at this point, it's a lot of cost takeout and expense increases elsewhere. So on the Network 2.0 stuff, when we get done with this Drive stuff, which is supposed to be done by the end of this fiscal year, we get into Network 2.0, and this is, a lot of what actually you referenced, Tim, in terms of the line haul, the empty mile reduction. They have not, indicated to the street that the cost savings for this are going to be super near term. They're talking about a fiscal 27, appearance for this cost savings. So it's interesting that you mentioned that they're already kind of working on this stuff. But fiscal 27 is what they've kind of promised the street in terms of an additional $2 billion of cost savings above and beyond the $4 billion that is supposed to come out from Drive. And so there's a lot of technology upgrades that they talk about in here. And Tim, you'd know much better than I about what all those could be. But from an outsider's perspective, it does appear to us that there could be a lot of work, a lot of improvement done on the technology side to modernize that.
I haven't seen it yet, and I'll tell you that it's not improved very much, and it's a very difficult pull for them because the ground systems are essentially the same as the systems they got from RPS all those years ago, and you would think that express systems are better, and putting those together has been it's had asymmetrical results, right? Some places goes okay, other places not so well, and we're not really feeling Network 2.0 out there yet. I mean, in some P&D areas, they feel it, and there's a few contractors that are picking up express runs to airports and things like that. But I think the 2.0 effort is still in the future for the ground contractor group.
Makes sense. There's another effort out there called the Tricolor. I'm not sure how much this will affect you, Tim, but it's primarily, I think, aimed at the express network, and it really talks about better utilizing, the FedEx Express assets, the planes that are out there, in a better way. Basically, you talked about moving empties around on the ground. There historically they had moved around plenty of empties in the air as well, and what this effort is going to be focused on is minimizing that. Lots of work to be done there, from a express, profitability perspective. Again, we don't know exactly what the express profitability is now because they've blended it in with ground in terms of how they report. But our best guess is that they're probably running at a 3 to 4% EBITDA margin for that business, which given the capital intensity of that business, it's just not good. We say they're not earning their cost of capital, so lots of work to be done there to improve FedEx, the legacy Express business.
Al, if you could go to the next slide, he's talking about FedEx Tricolor.
Yep.
Um,
So
yeah,
so
it's an interesting conversation there because when you listen to them talk, they talk about this color thing.
mhm.
So I know the colors are a big deal to them. Allie, we're on the next slide, please. I'm not sure what's happening.
Oh, perfect. We could actually go into the next one if as well on the
Okay, there we
competitive
go.
environment.
Yeah,
Perfect.
competitive environment. Yeah, there we go.
Thank you, Al. I appreciate it. So just looking, I just wanted to update this slide for y'all because I had a slide on the competitive environment last time, just to give you a sense of what's going on in terms
Go
of
backwards,
market
Allie. Go backwards. Go
share.
back one slide, please.
Yeah, FedEx today. Yeah, perfect, perfect. So yeah, so just wanted to go through give you an update on the competitive environment. We talked a little bit last time about how Amazon was gaining share, and per Pitney Bowes, which puts out the best summary of this situation in terms of market share that I've seen, Amazon actually took the #2 share last year. So they knocked UPS from a parcel volume market share perspective. They knocked UPS down to #3, and that would make FedEx #4. So Amazon Logistics obviously has taken a lot of share here. And when you look at the revenue that they realize, of course, it's a lot lower than what UPS or FedEx is realizing. So their revenue share is low. Their parcel share is gaining. A lot of that has to do with their business model. So it's not exactly apples to apples. Amazon does charge a lot, for example, for just sitting inventory in their warehouse, and that enables the fast delivery, next day delivery, the prime delivery that many of us have gotten used to. All that's driven by pretty expensive fees that they charge to sit that inventory. So not entirely apples to apples here, but in terms of what they're charging for the actual delivery service, they're not getting a lot of revenue relative to volume that they've been moving around. From a profitability perspective, just kind of taking a look here at where UPS and FedEx are. This is on a last 12 months basis. As you can see, UPS is still more profitable than FedEx, despite FedEx's efforts to increase their profitability, and despite what has been really a pretty tough year for UPS. UPS's margins have declined. They were in the mid teens area. They're now just barely holding on to the teens at 13%. But if you look at the free cash flow, still significantly more than FedEx. And if you look at the equity, market cap, almost 2 times, despite having revenue that's roughly equal. So clearly, the market still favors UPS, from a valuation standpoint. And so what we could do here is just go into the next slide.
Before we jump, we look at
Sure.
that market share. Those market share graphs are really interesting to look at, because it's going to be extremely difficult for FedEx to take share from Amazon, right? That's really going in the other direction. It's we might fight with UPS and might go 1% back or forth. So really, the only place to go get revenue or go get share is from the Postal Service, and a lot of what they carry is very low margin stuff, right? So
Yeah, sure is.
how does FedEx grow if they're going to stay at 18-19% of market? Right now, the market is down in terms of the gross volume that's out there, right? So where does FedEx get growth from in your
I don't think
estimation?
I don't think I don't think they can grow their market share, Tim. I don't think it's really possible. To your point, it's just not obvious where that would come from unless you get into a pricing war. And to FedEx's credit, uh, they talk a lot about profitable volume and making sure that the volume that they get is profitable. And I do think they're working their best on that to make sure that the volume that they are getting is good, solid, profitable volume. Um, so I don't think
Just a
the
reminder that we're going to have a Q&A. Oh, Matt, we're waiting for you to come back there.
can you hear
Go
me?
ahead and shoot your questions into the Q&A so we can make sure that we get them lined up for Matt to answer for you. In the meantime, Matt, we're back to you. We're talking about market share.
Okay, yeah. So yeah, on the market share side, I just don't see a way for them to increase volume. It's just not obvious to me how that would, increase their market share volume. Um, it's just not obvious where that would come from. You'd have to decrease your price, and given FedEx's focus on profitable volume, I think the market share will continue to decline. However, that does not mean, just because the market share is declining, it does not mean that volumes have to continually decline as well. What it does mean is the volume growth is not going to be as good as what Amazon is seeing, and that has really been consistent over the last decade. FedEx, while it's seen volume growth, has not been nearly as good as what Amazon has gotten. So I'd expect more of the same, Tim, in terms of volumes can grow. It's not that volumes can't grow, but it's just not going to be at the same pace as what Amazon is getting. That's my assessment of the situation here. And I think
Certainly,
UPS.
Amazon's business model is superior. If you just want to look at everything as a parcel market, the business model that Amazon has is, they're the Costco of these types of businesses. So, but the only way that FedEx is going to be able to grow revenue is the overall economy is going to have to grow. They're a bellwether. Them and UPS are a bellwether for what's going on in the economy. And what we saw in last week's earnings is not encouraging for what's going on in the broader economy.
Yeah, totally agree. I mean, we can talk a little bit about, FedEx. It wouldn't be crazy for them to try to replicate a little bit, to some degree, what Amazon has created. Essentially what Amazon has created is just the ability to deliver locally fast. So instead of doing things the 1990 way, which is, flying a single package across the US or across the world, what Amazon has done is they're taking, an entire container of the same stuff, they're splitting it into, X number of local distribution centers so that it can be delivered next day locally. There's no reason why FedEx can't offer some kind of a similar type of a product. It does change the business, it changes the business model, but given the revenue that Amazon realizes on that kind of inventory storage aspect of their business is so huge. It seems like a potential opportunity. I have not heard FedEx say that though. I have, and I don't expect them to make an announcement to that effect anytime soon. It's just my personal opinion. If you're really forward looking and you really want to, you're concerned with the loss of market share, you want to arrest that market share and you want to compete, over the next 2, 3 decades down the line, I think that's the way to do it because ultimately, low cost, fast delivery is what the consumer is going to be used to. So I don't know how.
Absolutely agree.
Yeah,
FedEx is on the ground side. I can't speak to the express side, but they're kind of doing that for Walmart and Target and Chewy dog food and some of these. Well, I shouldn't call it Chewy dog food. It's just Chewy anymore. So they've really focused on trying to grow their margin or grow their market share by being the Amazon for all of Amazon's competitors. And so in that particular scenario, the customers are actually holding the packages and putting them in locations where FedEx can deliver them next day or 2 days later. So they're kind of doing that, but FedEx is not holding any product for anyone. And I haven't even heard them whisper that they might consider that. So that's an interesting approach, but
yeah,
they're definitely not doing that.
got it. Yeah, I mean, it'll be interesting to see how we go down the line, but at the end of the day, they've got to deliver things fast, and it's got to be cheap. And I think the FedEx, the way it's set up today, it's either cheap or fast. You know what I mean? Um, Not a lot of products that they have are fast and cheap, but that's the way to do it. It's to sit inventory right next door to the consumer. Um, so we'll see how
Well,
that goes.
FedEx doesn't have the delivery model on the P&D side to be able to do same day deliveries. They don't have the technology to do that. And the transition to Network 2.0 requires that the broader ground contractor market adapt to time delivery, and the technology on the ground side doesn't exist. And so they're trying to figure out how to do that in small markets around, well, some big markets, Minneapolis and others, but they're tippy-toeing into the Network 2.0 from that standpoint. The future of this market, if you want to grow revenue and grow share, is you got to have dynamic delivery capability, right? If Walmart or Target has a customer order, it needs to pop up on your screen in your truck, and your truck reorders your next deliveries or pickups, and you go get that thing and bring it back. That's what Amazon is doing. And so the margin to be able to do that, the opportunity to do that, is you have to be technologically adept. And Amazon's just simply ahead of the market there. And this is why they continue to grow share, because they can do same day stuff. Some of that's, it's mainly coming from their distribution network, but they have to have the technology in their trucks to be able to handle that. And they are able to handle that, right? And so this is an advantage that Amazon has over FedEx and UPS. And this is why customer or shippers continue to put product in Amazon distribution centers and pay those high fees, because they sell more product that way.
For sure. Doesn't work for every product out there. It's got to be a high margin product, but for those that do have the high margins, it's the way to go for sure. I mean, the consumers are used to it. That's the issue, and increasingly so, every day more so. So, um, just want to take a look real quick on what's ahead. We talked last time, hey, it was super weird that they didn't include freight in this legal entity consolidation, and what about a spin? They are actually, as I mentioned earlier, actively looking at this. It would meaningfully affect the consolidated FedEx financials if they came out. You can see here, I'm pointing out FedEx Freight, the LTL business, consists of 11% of revenue, it's 22% of EBITDA, and importantly, it's a huge, more than half of their free cash flow. So this is a big deal. I would estimate, FedEx's market cap today is a little north of 62 billion. I think the LTL business alone is about half of that market cap. So if they were to spin this off, I expect the market cap of FedEx to be somewhere around that 35, 30, 35 area. So we'll find out soon what they want to do here. If I'm management of FedEx, I probably don't want to spin this thing out, just because it's such a big contributor to both earnings and free cash flow. Historically, the freight business has kind of bailed out the rest of the business, particularly Express. When Express is bad, usually freight is not too bad. So if I'm the management of it, don't, I don't want to let it go. However, shareholders are certainly going to be looking for this thing to come out from a from a returns perspective. The shareholders are very keen to see this come out. So I do, base case expect this to spin, and we should get some kind of a spin announcement before year end.
Well, I guess the key question is, do they spin it off or do they sell it? Spinning it off, it would still add value, maybe not directly to the FedEx. Depends on how they spin it off. If they spun it off as a wholly owned subsidiary, maybe it could generate some cash from stock sales or something like that. But I just can't imagine. I mean, it's probably worth $25 billion if you sell it. But then that's the end, right? There's no more free cash flow from that. You're going to have that $25 billion is going to have to last a while.
Right.
And the challenge in this market is the LTL market is very difficult. There's barriers to entry that are extremely high and thick. And FedEx is already in that market. And that's why that would have some value. But, they're kind of slow to respond to things in typical FedEx fashion, because XPO and others have jumped in to fill the gaps when Yellow Freight and others have gone out of business. And I think FedEx has not really gotten as much of that as they probably should have. But there's only about a legit 8 or 9, maybe 10 true nationwide LTL carriers out there, given the infrastructure you have to have. That's why that's worth so much money. But man, I can't imagine actually letting that go, right? That's like having the fastest racehorse and you sell him because
Yeah.
it's just crazy.
You rarely see it, Tim. You rarely see, a management team let go of, one of their best, if not their best business. So it would be unique. But that being said, shareholders want it to happen. Last time I showed the chart of XPO and how well it did. Certainly from a valuation perspective, the LTL business is worth a lot more, than the rest of this business. And so shareholders, most likely will be pressuring them to do it. It'll change the company a lot, and it will really put a lot of pressure on the company to execute on all of the cost takeout initiatives that they have, even more so than today. Pressure's on right now, but without freight is kind of a bit of a crutch. A good business, despite, to your point, it probably could be managed a little bit better. But even despite that, they put up pretty good numbers. So they kind of use it as a crutch historically. Without that crutch, Express will be laid bare. The cost needs to come out. The margins need to improve. Otherwise, FedEx could find themselves in a much worse situation from a equity perspective and valuation going
Absolutely.
forward.
Yeah, it's a danger Will Robinson decision, that's for sure.
Yep. Some other stuff that's going on the Express side. That USPS relationship is ending next week, so it's coming up here. That'll be gone. They have actually quantified that it's $500 million of revenue. Everyone's going to be watching, myself included, how the Express air network is altered after this. My guess is they're going to shut down a lot of flights after this is over. Remember, this is moving freight around or packages around for the USPS on a domestic basis. A lot of these flights, are not particularly, don't have a huge number of packages in them. So a lot of them are flying near empty. So I think they're going to shut down a lot of flights, and that could be a nice, actually, source of expense savings that could flow through. We're not going to see the efforts there fully for probably 6 months as they kind of wind that down and change their air network as a result of it. But that could be a nice source, and I think exiting that business, while it's just a bump in the road on the top line, could have a significant improvement actually on the bottom line. So we'll see how that goes. And we talked
Of
about
course, the challenge of getting rid of all those or not flying all those flights is you have the OPEX savings, but you still got the CAPEX sitting in the desert. And, and those are long-term payment plans. They don't buy that thing on 3-year terms, right? So that's going to continue to be a drag. And look, there's no market for those planes right now. They can't resell them. So it's going to be interesting to see how that proceeds. It's certainly a double-edged sword there.
Yep. And they'll need to make decisions on their fleet. They do have some older fleet, in the portfolio. What do we do? Do we retire that? Do we, continue our purchases of Boeing aircraft and continue the modernization effort there, or do we shut that down? All important decisions that they'll need to make in the coming years on their fleet there. Talked about the cost savings initiatives, so I won't repeat those there. And just, certainly this quarter was not a good one in terms of the evidence as far as their ability to keep the cost savings that they're taking out. From a volumes perspective, again, FedEx management is saying, hey, look, second half should be all right. And UPS, interestingly, is saying the same thing. So both FedEx and UPS are saying, we got a second half story here. Things will come back. Don't worry about it. We'll just have to see if that ends up being the case. The market is very sensitive to anything that's going on economically right now, and certainly FedEx and UPS both are viewed as, kind of canaries in the coal mine for what's going on for the economy. And there's definitely a lot of concern around, are we going to have a soft landing here? Are we going to enter into a recessionary period? So, everyone will be looking to FedEx and UPS for those volumes and to see how those come in the second half as an indicator for how the broader economy is doing.
Matt, that comment that they made about volumes in the second half matches what you see in freight waves pretty much across the industry. There's no expectation of volume increases until the second half. When it says second half of 25, they're talking about the calendar year 25, right? So that would be starting in June 2025, which would be FY 26 for FedEx. Maybe they get a little bit of increase in the second half of their fiscal year. What you see everybody else is talking about a calendar year increase in the last 6 months of calendar year 2025. That's typically what we're seeing, and FedEx is kind of insinuating that, which means for contractors, you got peak coming up, and I keep saying peak is going to be a bump. It's not going to be a peak. I mean, there's indications that the economy is sliding towards a recession. It might be a soft landing, or it might not be. You don't really know, but no one is saying get ready for a robust holiday season from a volume standpoint, right? So it's pretty likely that contractors are going to not get the benefit that you normally get of quite a bit of an increase in volume during the peak season. We did a poll here during this conversation, and what I'm hearing from all over the country is contractors are telling FedEx no when they ask for them to put extra trucks on for peak, because contractors don't trust FedEx. So you're going to add this truck and you're going to add this driver, and you may have to eat the cost on half the days you had them available, because the forecasting capability has not always been very accurate. And so you end up not doing very well. When you have peak bonuses, it's to your advantage. But in this year's contract, FedEx canceled the peak bonuses. So it's an interesting approach to how they're going about this. I expect that peak is going to be a purchase intensive operation for FedEx this year, simply because of the way they're going about it and the fact that volumes are down. And so for contractors, you got to plan for the next 9 or 10 months, you should expect flat volume. And going into January, February, it might be down volume. You might get a little bit of increase for the next 3 months, but the first quarter, calendar year 2025, it's going to be down volume. Remember when Matt talked to us back in June? Well, actually, it was back in late March last year, actually. But FedEx was reporting 2019 volumes, right? And we haven't had a tremendous increase in volume. we're still experiencing pre-COVID volumes here. It's not back to where even level with where it was pre-COVID. So you have to plan accordingly for that. That's why these are great conversations to have with an expert like Matt to help us understand this is what's going on out there. No guessing. This is what FedEx is going to do. And you should plan to operate your business that way. This is the water you're swimming in. And there's some waves out there right now. So you need to be able to handle the waves. So this is great data, Matt. I'm sorry to interrupt there, but I thought it was good to talk about those things.
Absolutely. Yeah, spot on, Tim. I agree with all that. And the only comment I had to just add on this slide was just in the pricing. FedEx feels strongly that they're going to be able to hold positive price in 2025. And we'll just have to see. It's to be determined. Historically, FedEx and UPS pricing moves pretty lockstep. And there's tends to be discounts that are applied, depending on the actual environment, the economic environment that we end up with. So, the ability to increase price has to be there for FedEx, even even with the cost takeout that they're doing. Investors are going to be looking for that. It'll be a big deal to arrest the kind of pricing declines that they've seen to some degree, and to make sure we're going in a positive direction there. So it's to be determined.
I think last week I saw that didn't they announce they're going to do an increase of like 5% price increase?
Yeah, and so that's a little deceiving when they come out with that, right? Because that's kind of the rack rate, and no, very few people pay the rack rate. I might pay it if I were to go ship something, but most shippers don't. Most shippers don't pay that. They get discounts off of that, and so and that's what we're the question mark is. Where does it end up being in terms of how it hits the financials and what discounts are ultimately applied to get the volume that they need to get the profitability they need. So we'll see.
Allie, can we have the next slide, please?
I think that's all we had, actually.
Oh, okay. All right.
Yep.
Great. Okay. Well, if you guys have any questions, shoot them here. We're going to review the polls here just so you know what we sent out. Matt, I asked the folks who were attending the summit this year, and the FedEx Summit's in Orlando next week, and about 60% of the folks on the call are going to the summit. That'll be interesting. I thought it was interesting that FedEx. I was on a call with for vendors yesterday, and there's 1,100 contractors going to be there out of 60. I guess the number of contractors, interestingly, has decreased from last year's summit of 6,800. The number of contractors now is 5,900. So that's decreased. And I think most contractors feel that FedEx is pushing towards having fewer but larger contractors. It'd certainly be an easier program to manage. Most folks feel that these conversations help them understand the ocean they're swimming in. So we appreciate you being willing to share your expertise. It's not us making it up. It's the guy that covers it for a living. That's just excellent feedback. 60% of folks have said the drive effort has negatively affected their revenue. Okay, so that's a great number right there. And only 35% of contractors on this call are planning to add capacity during peak, which is what we just talked about. That they don't expect peak to be much more than a bump, and they're not willing to take the risk, particularly when there's no incentives there to offset the risk. It's interesting. I know you don't know about these things, Matt, but every year FedEx changes how they go about incentivizing contractors to add capacity during peak. It changes every year. Mm-hmm. And this year they eliminated it.
Okay.
So there's no incentive. That's another way of saying, okay, we know you're not going to do it, so we're going to do all purchase. That seems to be the direction they're going. And 60% of contractors expect their revenues to go up in 2024. Part of that will be that FedEx gave us a decent raise in most locations, but 40% expect their revenues to be flat. So, that's kind of how the drive effort is impacting the contractor network on the line haul side in the marketplace. It's, we don't have all 17 or 1,600 contractors on this call, but we have a really good representative and portion, and I think that probably is a good analysis on what's going on out there. Does anybody else have any questions they want to shoot out here? I think there's a couple peak questions here, and as I said, I think none of us expect that the economy is not indicating that there's going to be a robust holiday season from a volume standpoint. FedEx is not forecasting that. So this is why this information is so good, because this is what FedEx is telling investors. They're required by the SEC to tell the truth. So what they're saying is we don't see any volume increases until next year. They didn't say we expect a 3% volume increase in this quarter due to the holiday season, and then we're going to be down. They didn't say that. They expect flat volumes. And so you should consider that in your FedEx line haul business. It's going to be flat volume during peak. One of the things we're seeing, Matt, and you may have heard this as well, I always say the FedEx business is local. It all depends on what location you're in. And, there's certain parts of the country that are really struggling right now. And so then you see volumes are way down there and contractors are being substantially impacted. However, if you are in Southern California or you are in the Savannah area, the southeastern part of the United States, FedEx business is booming, but it's a local boom, right? It's not indicative of a network-wide opportunity. It's very much local. Whenever you look at, hey, how many runs are getting posted by FedEx on a regular basis? The answer is none. There's no growth opportunities out there where FedEx is actually adding runs. The reverse is what's going on now. It used to be you could plan on your business growing every year. You're going to get a couple, 3 more runs every year. And you can't plan like that anymore. As I said back in the spring, the fundamentals of this business have changed. And that is, for the first time ever, contractor revenues are going backwards. And what we don't know right now is how much further back they're likely to go. I think the bulk of the backward move has probably been completed on the, shall we call it, the optimization side. There's still some room to move back, but we're going to be nothing more than flat for at least the next 6 months. And we have to plan accordingly. And what we've seen today from Matt is what FedEx is telling us. They're going to be flat till the second half of calendar year 2025. So plan your business accordingly. Growth opportunities here are getting good deals on people who are getting out of the business. There's a lot of that going on right now, but that's really the only way you can grow is get a good deal on someone who's getting out. I don't really have any more questions. Any other comments, Matt, for this team? We really appreciate you being here.
No, I mean, the only thing I'd add, Tim, to your color on the, kind of flattish back half stuff is, FedEx is representing, without giving numbers, that the declines that they saw in the first quarter and second quarter, they're representing the declines will be the worst in the second quarter. And a lot of that that they represented to us, to the investing world, was due to the calendarization. Because that Thanksgiving holiday shopping period won't be included in the quarter. So they left it, murky on the back half, but they're just kind of saying, hey, the declines you saw first quarter and the declines we're about to see in the second quarter, shouldn't be as bad. In the back half, we should see some stabilization. So, but overall, totally agree with what you said. Not seeing any reason for a robust, volume recovery whatsoever this year. And certainly, it's anyone's guess as to what it is next year. FedEx doesn't know. I don't know. The market really doesn't know. We're all trying to figure it out in real time. So we'll see how that goes.
Yeah, I mean, certainly the calendar quirk might affect the numbers that they report from the timing of that. I get that, given their weird fiscal year. They got a more weird fiscal year calendar than the government has. But
yeah, hopefully it'll change.
Yeah, so at any rate, that could be true from a market perspective. So at any rate, does anybody else have any other questions? Then we really appreciate everybody being here this week. And we'll not be here next week. We'll be at the summit. And then the week after that, we'll be back here with Motive talking about increasing your ROI using advanced AI. We appreciate everybody. Y'all take care.
Yeah, bye-bye.